Why won't you be rich with SIPs? That's right. What everyone tells you about SIPs might not be the full story. Let's break it down. The SIPs, or systematic investment plans, are often marketed as the easiest and most reliable way to invest in mutual funds. The idea is simple. You invest a fixed amount every month and take advantage of rupee cost averaging. It's the go-to advice from financial advisors, blogs, and influencers. Start an SIP early, be consistent, and you'll become wealthy over time. But here's a question. If SIPs are the ultimate wealth-building tool, why isn't everyone rich? But here's the problem. SIPs alone won't make you rich. In this video, I'll show you why, what they're actually good for, and how to truly grow your wealth. Most people start SIPs with small amounts, like 1,000 or 5,000 rupees a month. While this builds discipline, it's not enough to create meaningful wealth. Let's say you invest 5,000 rupees a month for 20 years at an average return of 12%. You'll end up with approximately 50 lakh rupees. Sounds impressive, right? But let's put this into perspective. 20 years is a significant chunk of your life. Think about all the milestones you'll cross in that time. Career growth, family responsibilities, and lifestyle changes. And here's another catch. 20 years later, 50 lakh won't have the same buying power. Inflation eats into its value, meaning your 50 lakh might only be worth 20 or 25 lakh in today's terms. That's barely enough to buy a decent car or cover a few years of living expenses. 20 years. It's not just numbers. That's 2 decades of your life. 2 decades of changing jobs, raising kids, and facing unexpected expenses. Are you okay waiting that long for a goal that might not even align with your future needs? Imagine waiting 20 years, only to realize your wealth can't even support basic dreams like buying a house or retiring comfortably. That's the harsh reality. SIPs work well in theory, because they average out market highs and lows. But here's the problem. Market returns are not consistent year over year. Some years, you might earn 20%, while in others, you might lose 10%. Take 2008, during the global financial crisis. The Indian stock market dropped nearly 50%. Or in 2020, during the COVID crash, portfolios saw steep declines. If you were investing through an SIP in those years, your portfolio could have been in the red for months, even years. Periods of low or negative returns can significantly delay your financial goals. Imagine needing to withdraw during a downturn. You'd end up locking in losses instead of gains. Markets do tend to recover over the long term, but these phases of negative returns can derail your plans if you're relying solely on SIPs for critical milestones. Let's be fair. SIPs have one major advantage. They build discipline. By automating your investments, you create a habit of saving and investing regularly, which is essential for wealth creation. SIPs can work well if you're saving for specific goals, like your child's education, a marriage, or building a house. However, if your goal is financial freedom, where your money works for you instead of the other way around, SIPs alone aren't enough. They lack the scalability and flexibility needed to create substantial wealth. Relying solely on SIPs for wealth creation is like trying to win a marathon by walking. It's steady, but it won't get you to the finish line fast enough. To truly grow wealth, you need to diversify your approach. The money you save through SIPs can serve as a launchpad for bigger opportunities. For example, you could invest in high-growth stocks, start a small business, or even explore real estate for passive income. Now, real estate has its own myths, which we'll debunk in another video. But done wisely, it can offer steady passive income over time. Here's the takeaway. Consider revisiting your SIP contributions every year and adjusting them as your income grows. Scaling up your investments is the real game changer, not sticking to a fixed amount. So, while SIPs are a great way to start your investment journey and build discipline, they won't make you rich on their own. They're fantastic for short-term goals, But financial freedom requires scaling up, diversification, and a strategic approach. Your financial journey doesn't end with SIPs. It starts there. So what do you think about SIPs? Have they worked for you? Drop your thoughts in the comments below, and don't forget to subscribe for more insights on personal finance.